Joining us now to talk about how the Fed will likely view the latest inflation data. Former St. Louis Fed President Jim Bullard. He is now the Dean of Purdue University's Mitchell E. Daniels School of Business. Great to have you, Jim. Thank you for being here. I first want to get your take on today's PCE data and whether it signals to you that we've mission accomplished on inflation.
This was a good report, right on track with what markets were expecting. This will put the Fed squarely on rate cut in September. And I think it's going to be 25 basis points. And I think the debate now will shift out to the November-December meeting. And I think the baseline there is 25 basis points at each of those meetings as well. And it is a soft landing, and I think it has been achieved. I think Jay Powell's speech at Jackson Hole was essentially recapping the success of monetary policy over the last 2 years.
So soft landing, it sounds like you're still expecting a gradual cutting of rates, 25 basis points, maybe some debate thereafter. What are you looking for in next week's payrolls report that could change that dynamic for you?
Yeah, I think this is, I think the debate, because of Jackson Hole, I think the debate's shifting. So now if you got a surprise in any of the upcoming reports, I don't think it would affect September. It would affect the debate about what to do later this year and focus on November. So for instance, if the payrolls report was very hot and showed a thriving jobs market, that might call November into question about whether the committee would do anything there. If it was a very weak report, let's say, close to zero or something, then you might get debate about whether they need to do more. But I think the do more would be farther out in the future, not at the September meeting, because I think they would just shrug off any data that's coming in now between now and the meeting as just one data point, and they wouldn't probably react to that.
I've seen some criticism that people believe the Fed may be acting too short term. Obviously, they need to be data dependent. Obviously, we are in unprecedented times during this cycle. What do you make of that criticism, especially as we kind of reflect back? I know the Fed is also doing that retrospective, looking back at just the massive inflation we did see over the past few years and the monetary transmission mechanism and the potential gaps therein.
Yeah, too much short-termism. Well, I don't really think so. I think that I would interpret the first half of 2024 as a time when the committee was buying insurance to make sure that inflation didn't resurrect and go back up higher. And for a moment there, it looked like it might go higher, but it ultimately did not. And this report today confirms that. So I think it maybe was wise to be very careful and make sure that inflation was really coming down to the 2% target before they started an easing cycle. And so that all makes sense, I think.
Jim, I don't know did you hear it's Brian Sullivan, by the way. Did you hear the previous conversation?
Yes, I did.
Listen.
You want to talk boat prices?
Well, I would like to know what listen, you've always been a great guy and a straight shooter. And and by the way, congrats, Purdue, great school, go Boilermakers. By the way, boilers are also up in price. I just wanted to point that out. But here's the thing. How much, we know we needed 2020 COVID disaster economy shutdown. How much do you think the 2021 COVID stimulus and the PPP COVID stimulus contributed, if at all, maybe zero, Jim, to inflation?
Now that I've been telling the story about the causes of the big inflation, and it's very, very much that the March-April 2020 response to the pandemic was big, and it was meant to be big, and I think it avoided a financial crisis. But then you got another package passed by Congress at the end of 2020 in December, bipartisan, very large. That was because of the Georgia election. And then again, when the Democrats came into power, as probably any party coming into power, they wanted to do something, so they passed another package. It's those two last packages that were overdone. And that's what led, right after that, we got a whole bunch of inflation, and we're still keeping the policy rate, very low in that environment. And then we had to scramble in 2022 in order to bring this under control. So I very much think that that's what caused the inflation. And a lot of that spending was actually, basically going directly to people's bank accounts. That's about as close to printing money as you can get. And I think if a new Congress is coming up in the future should learn from this, that all you get is a bunch of inflation if you try to do stuff like that.
But if you look at the economic proposals of the two candidates running for president, you would say that there is a risk for that inflation to continue due to the impact on the deficits. Is mixed government kind of the only way to combat that if there's divided government in terms of party?
Yeah, I've been telling audiences that that's our best hope, that you get a split House, Senate, White House somehow between Republicans and Democrats, and that probably would keep the spending down. Even very narrow majorities are hard to work with, so you probably wouldn't see a lot happen. But still, I'd like policy nationally to kind of return to what I would say is a little more sensible grounds and try to put us on better footing going out into the future. But it doesn't seem to be happening. Both parties seem to be going more and more into bigger and bigger deficits out into the future.